All right, let's head to the Notepad. What we're going to cover is I want to understand, and more importantly, I want you to understand yourself what is important to you. When I say what's most important to you, what comes to mind? Is it growth? Is it income, safety? So we'll talk about that. We'll cover the 4 places to invest, our indexing simplified, where you get both growth and safety at the same time, our break even scenarios, an old school math equation that every financial professional understands and knows that's there, but either them or maybe possibly yourself are not playing by the rules of the rule of 100. But we'll get into that. That's a fun one. The buckets of money, our comparison to the Roth versus our tax-free plan. There's 3 types of tax diversification. Okay, so you need 3 types of money to be truly diversified. And I'm not saying that all if your money is all in the stock market, that is not true diversification. And we'll talk about our retirement accounts. There's 3 types of retirement accounts that are available. All right. Now, as you can see, these are all important. Okay, you would agree with me that these are all important. I want to know, and I want you to know, what's the order of that for you? What's the order of importance? So if you're married, both couples, you can have your own separate numbers. And remember, the order of importance, they are important today, and they could change in the future. But what are they today? Married couples, your orders to be different. And if you're single, you can just cross out that person or not include them. So let's say, is it income? Is growth secondary? Is it reducing taxes, number 3? Protect your assets, leave an inheritance for your children or charity or your business. Long-term care may not be the most important, depending on your starting age. So that might be number 7 last. And liquidity, you may have cash reserves, emergency funds already built up, so liquidity is not that important. But I want you to, what is important to you? What's your order of importance? And then allocate money that's going to provide these outcomes for you. Here are the 4 places that you and I can invest our money. Now, obviously, there's much more options than 4 that you and I can save or invest, of course, but these are typically, it squares down just to 4 options that are available. Comes down to 4. So we have the bank, we have the stock market, the insurance industry, which this is all about here, and we have real estate. 4 options, 4 completely different options, 4 different outcomes, and they're all great options. Okay, so what is the outcome you're looking for? And that's where you put your money at. Not all of your money, but a portion. Now, when it comes to the bank is the rate of return is anywhere from 0 to 0.5%. The rate of return. Okay, but why do we go to the bank? We all go to the bank because of what? Yep, that's right. FDIC insurance. All right. We'll talk about that at the end. FDIC insurance. We put our money in here and we can take it out because it's liquid. Okay. Liquidity. Do you know that the banks are still failing? I wanted to mention that. Did you know that banks are still failing today? They're so small that they're not in the major news because they're so small, but they fail every day. On average, 23 banks per year still fail. Now, they're so small that nobody keeps track of them. You and I put our money in these institutions because it's the safest place that you can think to put your money in. But remember, we're talking about retirement money. That's the only thing we're talking about is retirement money. Maybe college money, if this is why you're here, and maybe legacy money. That's maybe why you're here. But for the majority of people that come to me and come to our firm is because we're talking about retirement money. So income planning and future money. Okay, so should you keep large sums of money in the bank? I'm not sure you should, but people do it all the time. Now, when we talk about the stock market, what's the rate of return in the stock market? People give me numbers anywhere from 8 to 20%. All they're doing is they give me the high number, but nobody mentions their losses. So let's just say anywhere from 10 to 18%. Now, when it comes to retirement planning, income planning, and legacy planning, we have to deal with the facts and we have to deal with the real numbers. So I'm going to put my money in the market. If I'm going to put my money in the market, I want to make sure it's somewhere between 10 to 18%. If I'm going to assume all the risk. Okay, so that's the other thing. We assume all risk. And that's both money and time. Okay, money and time. Okay, money's at risk, your time's at risk. If you do any research, the average rate of return for the last 20 years was a little over 9%. But you still have to factor in inflation, taxes, risk. The real rate of return after that, it comes out to about 3%. Okay, and the other thing is, what are the guarantees? There are no guarantees that the money will even be there when it comes for you to actually take it out. And of course, you're paying anywhere from a 1 to 3, maybe 2% money management fee. Okay. A 1% fee. Now that's on the front end. All right. That fee's on the front end, meaning you can see on paper. Yet there's a ton of hidden fees in the back end that are not transparent because they're not required to give you all the fees, all the hidden fees that are baked into these tax deferred planning plans. I have a whole document, a whole PDF that actually breaks down the hidden fees, charges, things like that. Now, with us, with these tax-free plans, we are very transparent in our private sessions where I actually go over the costs of these tax-free plans, and so we're very transparent on that. Now, that management fee, remember that management fee is going to grow over your lifetime, okay? Because the more that money grows with interest and more capital that one advisor has under management, he's getting paid for a lifetime. And those fees grow over your lifetime. With us, what's different about us is the fees in these tax-free insurance plans, they decrease over time. They get cheaper as you age. Okay. This is long-term planning for this for our tax-free strategies. All right, is this making sense? So fees, no guarantees. It's all growth focused. So people play the game. It's a good game to play if you understand it. You want to be invested in it. But when it comes to retirement planning, overall, people see the stock market as growth only, still even for retirement. And then for our real estate, we have great option. I love real estate myself. We have our appreciation and we leverage the equity. Okay, so that's huge benefit of real estate investing is our equity. We get a lot of great tax benefits as well. And we do it for the cash flow, okay, passive income, semi-passive. But the cash flow, we want income, okay? We want all these things that real estate is providing for us. Now, it does come with its own risks. A bad tenant, something breaks down, a fire, So there's risk to it, but we all that's understood. So that's another great place, another great option for putting your money for your future. If you're using real estate as another part of retirement for future income, that's another great option. Stock market, of course, we covered that. Now, let's talk about the insurance space. Now, the insurance industry is the most financially stable institute in the world. It has more money than any other financial sector. Did you know that? Just look at when you go to any downtown in any major city and you look up in the sky, you're going to always see a bank and you're going to see an insurance company. Do you know that when it came to the Second World War, when our war bonds were no good, our country didn't have any money? Now, guess who funded the Second World War? Well, guess. Yes, you guessed it. The insurance industry stepped in. It wasn't until 1997 until the insurance industry entered into the retirement space and they started out paying a rate of return. Now, prior to 97, most insurance contracts paid out a dividend or a variable contract, like stock market strategies, variable contracts. Now, which was a version of securities. Okay. Now, our plans are called products. What you have is called an investment. Okay. Now, in the insurance space, these products are their version of investments in the security space. Does that make sense? But it's the insurance company's version of retirement, and they're called products. The insurer bears the market risk for you. Okay. Here in the stock market, you're bearing the risk. So that's the total opposite, day and night, black and white. The insurance company bears the risk for you. In the stock market, if someone's managing it for you or you're self-managing, you still bear the risk. All right. So that's why the insurance space is so vitally important to have a portion of assets tucked in inside here. All right. You can get anywhere from 5 to 14%. Okay, these are predictable rates of return, decent but predictable. Don't come in here thinking you're going to get a big swing in the market, get 30, 40%. Okay, now could you achieve those things? You certainly could because there's certain features in our growth strategies that we can turn on that if we feel there's going to be a bull market, then we can turn those certain features on to capitalize on that. However, when it comes to an expectation, you're going to get decent predictable. So 5 to 14%. There is zero risk here because of our indexing. You have safety of your money, okay? Your principal, safety of interest, and safety of the actual institution who is investing the money, managing the money. Okay, so you have safety of the actual institution. And there are no money management fees. Okay, no money management fees because these accounts do not require active management. I don't have to do anything. You don't have to do anything. It's self-managed. These insurance-based strategies, it's self-manages itself. So once you do qualify, we will meet in our first quarter. So we'll meet every quarter for the first year. So we'll meet each quarter of the first year, and then we'll meet every year for life for that. So I don't get paid a fee. I get paid one time. I talk about that later, but I get paid one time. I get paid directly from the insurer, the provider. They pay me directly, and that does not come out of your money. Okay, so whatever you put into the plan, it goes in dollar for dollar. So there's no management fees here. And part of the safety, if we talk about that again, is part of the safety is what's called reserves. So every insurance company in the United States needs to set aside a portion of what you put in to the side, and that's governed by a body of insurers and a board. And we'll talk about that towards the end, but there are reserves. So if an insurance company goes belly up, bankrupt, catastrophe, you are going to get a portion of your money back. which is great. And they do have guarantees. Okay, not a guarantee rate of return because no one can say that, but there are guarantee you will never lose your money. And also, one thing that I do love about this is that it comes with free long-term care provisions. Okay, no charges for it, comes for free, along for the ride. This is part of that 2-for-1 retirement vehicle that I mentioned, the 2-for-1, that it has a savings component, okay, the savings component for retirement income. Then it has the actual benefit. That benefit is for both living benefits, which is long-term care, living benefits, long-term care, and then legacy. Okay, so that benefit, that insurance portion, okay, the insurance portion of the 2-for-1 is used both for long-term care and for legacy. Okay, the 2-for-1. And then part of the indexing, we'll get into the indexing in a moment, but it has what's called the lock and reset feature. And then we have this is where banks and corporations invest their money. It's called BOLI or COLI, banked owned life insurance, company owned life insurance. So this is where they put a lot of their capital, a lot of their excess money, profits into the insurance space because of everything I'm sharing with you up until this point of why people use these accounts. Now there are caps, okay? There are caps. That's why I say it's decent, predictable rate of return because you have the indexing for both safety and growth. So there's caps. To get the safety of no loss, there's a cap of how much you can make, even though what you can make as far as interest is good. Okay, there's no greed here of trying to get the most amount of rate of return. Okay, and you have to qualify. Okay, you have to qualify for this. There's qualifications, medically speaking, and you have to be eligible. You need to have the money to put into this plan. Okay, $1,000 minimal to put into the plan, or if you have cash set aside that you want to reallocate, you have chunks of cash you want to put into the plan. That's the only exception to the rule if you're not funding at least $1,000 per month. Now there's conversions. You can go from tax deferred to tax free. That's our migration strategy. But you need to have the money. Okay, you got to qualify medically, and you have to be eligible. You need to have actual funds and enough time to put the money into it. Okay, so time as well. That's called HAT. Okay, this is the qualifications for this plan. You got to qualify medically, and you need to be eligible. HAT. Okay. Habit, ability, time. Habit is do you currently have a savings habit? You need to have a current savings habit so you can continue to have that if you decide this is the right plan for you. And ability is, do you have consistent income? Okay, you need to have consistent income to fund it. And time is, do you have enough time for you to fund the account so that it can work out for you in the latter years. So 10 years minimum, 10 years uh, to let this thing be funded and let it grow. So this is a 10-year plan. Okay, so this is a 10-year plan. So it's liquid, of course. There's liquidity from day one. However, I discourage anyone from taking money out so quickly. If that's your intention, if you plan on taking money out of this account for investments elsewhere, please let me know because I can structure it um, to do that for you. But how I design them from the get-go. Yes, it's liquid, but don't take money out of it. It should be the last place to take money out. And we'll talk about leverage later on, how to leverage the account. All right, there are no contribution limits. So there's no limitations, there's no penalties, there's no restrictions here. All right. How are we doing so far? So those are the four places that you and I can put our money for retirement purposes. Okay, for retirement purposes. The four places: the bank, the insurance space, stock market, real estate. All right, so let's go into the indexing. All right, so what we're going to do, this is a this is going to be our plus 10, minus 10 average. All right, so this is going to be how I'm going to show you how this works. So plus 10, minus 10 for our example here. So let's say you have the green line. Green line is our indexing. The red line is the stock market. Okay, so this is a comparison. We got 100,000, and then in year one, we earn 10%. So your account balance is 110,000. So if this was in the stock market, you earn 10% in year one. So let's say in the following year, year two, the market tanks, and now you're at 99,000. In year three, the market goes back up 10%. Now you're at 108. Year four, back down 10%. You're at 98,000. Back up 10%, 107. Down 10%, 97. Up 10% again, we're at 106. Down 10%, we're at 96,000. And up again 10%, 105. And then in year 10, we're down again 10%. Now we're at $95,000. Now, I have gotten feedback saying, hey, 10%, in 10 years, I lost 5,000. So I'm at 95,000. Not a huge deal, but I have to make you understand is that it wasn't the 5 grand you lost. You lost 10 years of time. That's what you truly lost was the time. You can't get that time back. Now, let's talk about our indexing method. Okay, what's going to make this plan even more robust? So let's say we have 100 grand in year one, we got 100,000. The first year the market goes up 10%, so we're at 110,000. Okay, there's nothing different. Now in year three, the market goes down 10%. Instead of participating, instead of losing money, instead of losing 10%, we're not going to participate. So you see how this is a flat line? This is where the interest expired, the upside option expired, and your principal balance. This is your principal balance. Your principal balance, the full 110 is protected. It was your interest you lost, not your principal. So your principal is always protected. And then what we're going to do, we're going to wait for the market to rebound. It goes up 10%. Now we compounded. Now our account balance is 121,000. If the market goes down the following year, 10%, we're not participating. We're staying flat. It goes up again, rallies, we're at 133. Down 10% again, we're not participating. It goes up again the following year, year six, we're at 146,000. And then in year 10, we're at 161,000 tax-free cash value. Okay. Versus the stock market where it's tax deferred and you're at 95,000. So that's how indexing works. And it's possible because of our lock and reset feature. Okay. So our principal 100,000, it goes up 10%. We're at 110. It locked and it resets itself every single year. And it's going to do that for life. Okay. Now, the average rate of return in Wall Street's eyes in the investment world is they'll tell you that you've earned 10% because they're just taking the average. That's what they'll tell you that it was 10% was your rate of return. However, the actual return was negative 5%. That's the real math. Because if we really think about it, if you lost if you lost 25% in the market, do you realize that you have to gain 33% just to break back even? And if you lost a third of your money, you have to earn back 50% in the stock market to break back even. And if you lost half your money, you need to achieve 100% rate of return just to get back to where you started. These are not realistic gains, not even close. Now, however, these losses, these losses are real. That's more realistic. That's why it's important to understand what's the rule of 100. So let's say you're, I'll just use one example. Let's say you're, let's just say you're 60, okay? 60 minus 100 is 40. Okay, I'm going to put a percentage, 40%. 40% means you can afford to lose 40% of your money in the stock market. The other 60% needs to go towards other options, guarantees, safety, certainty, income, reduced taxes, things of that nature. So remember the order of importance that we talked about earlier? That's where this 60% needs to go towards. And then the three buckets of money is you need to write this down. If this was a one-on-one session, I would put in your actual dollar figures in these buckets, but I want you to do this. There's three, so you and I, any one of us can have our money placed in up to three or a minimal of three buckets. So we have our qualified bucket, or we have our qualified bucket, which is our tax deferred. These are IRAs, 401s, or stocks. And this is where the interest and the taxes are deferred. And then when we pull the money out, it's taxed on the full amount. Tax deferred does not mean tax free. Yes, you get a tax deduction on every year. However, when you take it out, it's not tax free. So that's not tax free. So this is stock market. This is volatility, uncertainty. This is no guarantees. This is our qualified bucket. This is where people have anywhere from 80 to 100% of their money locked into these accounts. We have our tax-free bucket. Okay, interest access is tax-free. This is where you get power of indexing. Remember, zero is your hero. There is no market recovery. So when you retire, let's say the following week, the stock market tanks after you retire, your money inside this account are these insurance-based strategies. There's no market recovery. So if the market tanks, your money inside this account is still there. Okay, so you can access the full account value. You can still pull money out during a down market. And there's liquidity tax free, and this is where you're able to eliminate risk, fees, and taxes. Now, people have little to no money here. All right, 0 to 1%, little to none. And then we have our non-qualified bucket. Non-qualified, the taxes are already paid, or you're taxed every year. This is where our savings, checkings accounts, mutual funds, money markets, CDs, bonds, ETFs, real estate, interest is taxable, less tax efficient, but still pliable. Most people put or they reinvest their dividends or they reinvest their cash flow into this bucket, and of course you're taxed on the distribution, the gain, the sale, the income of this. So this is your three buckets of money. This is where 50 to 80% of money is in here. Now the goal is when you near retirement, you need at least 5 years to plan for retirement, at least five. So there's enough time to take money out of this bucket to put it in here. And then you take some of this cash and put it towards here to be better balanced in the tax-free side of things. Now, when we compare the Roth IRA versus the tax-free retirement account, if we look at the Roth first, okay, what makes these similar first is they're both after-tax money. Okay, you pay the tax. Now I have this post-tax dollars. Where do I disperse it? So these are both the same after-tax money. Now, here are the differences. So we talk about the Roth IRA, it's a variable account. Okay, even though you can access it tax-free, it grows tax-free, it's still volatile. So you still have no guarantees there. Now there's a age rule. You got to wait till 59 and a half to touch it. If you do touch it before that age, you're penalized 10%. The only exceptions to that is if you're buying a first house, going to college, or a birth of a child, then you can access it early. Now, the great thing about a Roth is if you're under 59 and a half, you can still withdraw the contributions, but you're taxed on the interest, penalized on the interest. All right. Now, when you take money out, the Roth, it's owned by a withdrawal. So, as we discussed, when you take money from a withdrawal, you're interrupting the compounding, okay? Interrupted compound interest. So that's the downside. And also, when you pass away, there is no legacy, okay? It's whatever is inside the account at the time, so no legacy. The family gets the leftover account balance. Now, if you're under age 50, you can only put 7,000 per year. If you're over age 50, 8 grand per year, okay? Not even a month. That's not a lot of money. So it's a good option, okay? But there's a better option. So let's talk about that. The tax-free retirement plan are insurance strategies. You do have uncapped growth. That's a I did say there are caps. Yes, I did say that, and that's true. And there's also strategies where there's no caps. Okay, so there are no cap options, but I believe there's a charge for that. But we'll talk about that privately when it comes to personalized accounts. But there is uncapped growth, and there's caps as well. Um, so there's two different ways to grow your money. And our safety net, okay, anywhere from 0 to 1% floor. So the least you can earn is 0% or 1%. So that's our safety net. No age limits, guys. Okay, you don't have to wait till 59 and a half. You don't have to wait till, there's no RMDs here either. Okay, there's no restrictions. You can access the money for anything, home improvements, investment opportunities, new business venture, retirement. Okay, there's no auditing of the money. Now, some investors use it to become their own bank. So they can contribute to the plan for a number of years. Then, once that account is sizable, start pulling money out, in year 2, year 3, year 5, start investing to become their own bank instead of getting all their capital directly from a traditional financial institution. So these plans can be your own bank. And when I mentioned taking the money out the smart way, you take the money out in the form of a loan. So when you take the money out in the form of a loan, you're not disturbing the compounding. So it's uninterrupted compound interest. You get a legacy. Okay, your family gets the money that you put into the plan plus the insurance. All right, so that's tax free. Okay, and there's no contribution limits, no income limits. So if you make a ton of money, if you make 150,000 plus per year, you can qualify. You're eligible. You make a lot of money, so you're eligible. Now we need to find out if you qualify medically for it. So this is a better option on the tax-free side. And then just to tie a bow on this, when I mentioned the three buckets earlier, the three buckets, this actually ties into the tax diversification because we have tax deferred, we have tax free, and we have taxable. You need all three to be truly diversified. All three types of taxes, okay, not 100% in tax deferred. Okay, you need all three. And then our three types of retirement accounts is we have our employer sponsored, our brokerage, and our individual, okay, individual accounts. Our employer sponsored, you don't own it, okay? You don't own. That employer owns it. They set the limits, the restrictions, the penalties. Brokerage accounts, you don't control. That broker, that money manager, they control, they sell, they buy, they charge a fee. Whether you earn money, whether you lose money, that fee's still being paid. You don't control where the money goes. They do it for you. And try to get the money out. Try to move the money. into this space, they're going to give you trouble because their income is decreasing. But this is your money. Remember that. All this is your money. So make sure that that advisor is not discouraging you from moving or making changes. And then number three are individual accounts. This is where you both own it and control it. You set it up. I help you set it up. You own it. It's not in my name. And this is where you get the guarantees, the safety, the free long-term care, all the benefits that I mentioned. How are you feeling? Is all this making sense so far? Here's where you are right now. You can research financial products or services in the marketplace yourself. You can trust that your advisor is leading you in the right direction. Or you can learn the strategies that I'm going to implement for you at the most basic of circumstances, all the way up to the complex and intricate needs of those who want to add huge value to their existing portfolios. Let me know in the comments thoughts and questions. Do you like it? How do you like it? Do you need clarification? So I gave you a ton, and I hope this is really grasping why you should consider this as a viable option for your retirement. Go to the next lesson, and we're going to talk about what you're going to get. Okay. We're going to tie it in what you're going to receive if you decide to find out if you want to use this as a retirement option. So next, we're going to talk about what you're actually going to get to tie it all together.